September brought a slight slowdown in annual home price gains, yet October's pending home sales jumped to a yearly high, showing buyer demand is still holding strong. At the same time, the government finally released key reports delayed during the shutdown, including September retail sales and wholesale inflation. Let's break down the numbers and what they could mean as we head into year end. Good afternoon and welcome to December. I hope you had a wonderful Thanksgiving weekend with your loved ones and are ready to finish off the 2025 year strong. We're just about a week away from the final Fed monetary policy decision, and if things couldn't get any more interesting, the decision whether to cut rates or leave them unchanged is getting more and more complicated. After the minutes from the last meeting were released, it showed that there was a clear divide between the Fed members on whether a cut or pause to their Fed funds rate was needed, and after a delay of over 40 days with extremely important economic data, that line between members has seemed to only get wider. With inflation staying above the sticky 2% goal, but the labor market deteriorating more and more each week, what will be the news out of the Federal Reserve to cap off a wild 2025? Let's dive into what took place last week, and that leads us up to their final meeting of the year. Here are your headlines. The government released delayed September producer price index data showing wholesale prices rose 0.3% from August and 2.7% year over year, both in line with expectations and largely driven by a 12% jump in gasoline prices. Core producer prices, which exclude food and energy, increased by 0.1% on the month and 2.6% annually, both slightly below forecasts. So what's the bottom line? Wholesale prices feed directly into the Fed's preferred inflation gauge, the personal consumption expenditures. While some shared components, such as airline fares and nursing home care, rose, others, including portfolio management and hospital outpatient services, declined. Overall, this report isn't expected to spark a meaningful increase in September's PCE reading, which is now scheduled for release this Friday. After delays caused by the shutdown, the government released September retail sales data as well, showing a modest 0.2% increase, below expectations and well under August's stronger 0.6% gain. The control group, which excludes autos, gas, building materials, and food services, slipped 0.1%. This marked the first decline in 5 months and matters because it feeds directly into GDP calculations. So what is the hope? September's softer spending suggests consumers may have started to cool heading into the fourth quarter. The delayed October and November reports will be key to understand whether this slowdown has become a trend. Now in housing news, the Case-Shiller Home Price Index, one of the most widely followed gauges of U.S. home values, showed 0.3% monthly decline from August to September before seasonal adjustments, but a 0.2% increase after adjusting for seasonality. Nationally, prices are still up 1.3% higher than a year ago, a slight up from August's 1.4% annual gain. So what is the future outlook? Home prices remain above last year's levels, but appreciation has cooled. If mortgage rates continue to fall, buyer demand could strengthen and potentially push prices higher again. Now, one of the reports the Fed will be able to dissect before their meeting next week is the weekly initial and continuing jobless claims. Last week, initial jobless claims fell by 6,000 to 216,000 in the latest week, marking their lowest level in 2 months. However, continuing claims, which is people receiving benefits beyond the first week, rose by 7,000 to 1.96 million, which is one of the highest readings in 4 years. What is the bigger picture? Even as initial claims remain relatively low, the sustained rise in continuing claims, which is above 1.9 million since mid-May, signals that displaced workers are taking longer to land new jobs. This points to an overall cooling labor market. This week is shaping up to be a major one for the economic outlook. We'll get fresh labor market insight from ADP's November employment report on Wednesday, followed by the Fed's preferred inflation gauge, the PCE, on Friday. If PCE comes in softer than expected, it could all but lock in a rate cut next week and bring additional relief to mortgage and long-term rates. One important reminder, the Fed funds rate does not directly control mortgage rates. If you have clients waiting for, quote, the Fed to cut again before making a move, it's worth educating them on the distinction. In fact, during the last 5 rate cuts since September of 2024, mortgage rates actually moved higher in 4 of those instances. If you need talking points or want help explaining this to clients, I'm always here to help. Otherwise, have a great rest of your day and a good start to your December.